Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value or anything out of these videos, I'll ask you a thumbs up and subscribe. Questions, comments, put those below. We can't start things off without touching on U.S. CPI data. Something we've been talking about a lot on the show, also going in depth on it on the Looney Hour podcast there. But U.S. CPI clearly showing signs that it has peaked and is rolling over, coming in at 7.7% on a year-over-year basis. Below market expectations. So obviously, if you're paying attention to the news and the stock markets, obviously, ripping higher on the view or the belief that, inflation might be behind us. Again, I think it's personally premature because what happens is you get an increase in the stock market. Let's say house prices start going up again. That basically loosens financial conditions, which is exactly which central banks, particularly the Fed, are trying to tighten. So stocks going up, aka creating a wealth effect, making people feel wealthier, and then thus going in and spending more money into the economy is not what central banks want. So it is kind of a very dangerous, slippery slope. But again, clear signs that CPI inflation is rolling over. I think it's much too soon to start cheering and doing the happy dance. But I think, again, from a rate of change perspective, I think the peak is ending. If you look at, the largest component of CPI continues to be shelter. It's a huge lagging component. If you strip out shelter from the core CPI, it actually fell for the first time since May of 2020 during the depths of the pandemic. Now, again, people say, well, you can't strip out shelter. Shelter is such a large component of everyday's life. It's still showing that shelter is actually increasing on a monthly basis. But I mean, it's interesting because you go and pull the financials, the public reporting of the largest residential REITs in the United States, and three of the largest residential REITs in the U.S. are saying that the rents are flat or declining, and so it doesn't quite square with the data. But again, this is probably why shelter inflation lagged on the way up, for example. So keep that in mind. We kind of walk through this data. But on the news, obviously, bonds rallying. So basically what that meaning, yields coming down. If you look at the Canada 5-year bond, which prices a lot of our 5-year fixed rate mortgages, that's down about 30 basis points over the last couple of days. So that's a huge move in the bond market. So again, is that a question mark of have we seen the peak in fixed rate mortgages? I think we have personally. If we haven't, we're getting extremely very close. It's kind of been range bound really over the last 4 to 5 months. But again, at the end of the day, rates are still very, very elevated. And I think they're still restrictive for the housing market. So again, way too soon to start doing the happy dance, because at the end of the day, the damage has already been done. We've been talking about this for a while. All you have to do is look at household interest costs as a percentage of disposable income. Here's the chart for my good friends at Variant Perception. Guys, look at, this chart really says it all. Interest costs have exploded higher. This is going to have a significant impact on consumer demand. I think we can all agree that in Canada, our economy, right or wrong, has been built on housing. It's been built on house prices going up. If you have too much debt, you simply just refinance it. If you want to go and buy a car, buy a boat, hey, your house goes up $100,000 every year. You can simply tap into that home equity line of credit, or you can, again, refinance, pull some of that cash out, and go spend. And so that's really what our economy has been, again, right or wrong, for many, many years now. So the fact that these interest costs are now surging on this massive debt pile, it is deflationary over time. You just have to give it time. So the damage has been done. I think we all know the stories of, my neighbor that's over leveraged, that, refinanced, bought a pre-sale condo, or they floated their variable rate mortgage, and now their monthly mortgage is up $500, $600, $700, $800 a month, and they're starting to have to cut back elsewhere. These are going to ripple through the rest of the economy. So again, the damage is already done. We know that the Bank of Canada is obviously started to signal their slowdown for rate hikes. Markets are pricing in 25 basis points in December. I think it's 25 and done in December. But again, like we said, the damage has already been done. All we have to do is look at now. We're going to start to see where the bodies start to surface across the rest of the market. We had one of Canada's largest private lenders, Romspin, one of the over $3 billion worth of assets just gated their funds. So what that basically means is they're not having loans turning over. So basically, here's how it works. If you're a private lender, so your typical borrower, let's say, is a person that can't qualify at RBC Bank. They're maybe self-employed. They don't have the greatest T4 income. They have some whatever. They end up going down the private lending channel. These private lenders issue them a loan. They say, we don't really care about your income. All we want to know is, hey, listen, do we have enough equity in the property? Yes, we do. Okay, we'll give you, 70% loan to value. There's 30% equity in the property now, and this is a 1-year term. Most of these private mortgages are meant to be short term in duration, right? So the idea is in 1 year, you're going to go and refinance and get a traditional loan because your credit situation is going to improve, your salary is going to go up, what have you. What we're seeing now is on the ground is that these loans now aren't turning over. So they're coming up for renewal, right? So someone would have got a 1 year first mortgage at a private lender last year, let's say 6%. Today that rate is closer to 9%. So that becomes extremely hard to then refinance out of it. Not only that, because prices have dropped. And so these homeowners are saying, well, listen, I need a renewal. And a lot of them are saying, well, we don't want to renew you. We actually want the cash back because we have investors calling us and saying they want to pull some of their funds out. We need to pay them back. And the guy says, well, come and get it from me then, basically, right? You have to force me to sell. And these lenders don't want to go through that process of going and selling because it's expensive. It's very hard to do in most of Canada. It's a lengthy process to go to court, file the paperwork, hire lawyers, and then get a court-ordered sale and then go through that process. So what they're having to do basically is just automatically renew these people, even though they don't necessarily want to. And so these investor funds aren't turning over to actually pay out redemptions. And so we're seeing now, I think, a serious signal in the market that says, hey, listen, we have to gate funds. Investor money can't leave. And if you think Romspen is going to be the only one, I can tell you that moving forward in the new year, you will see a lot more of these private lenders will have to gate fund and this is the liquidity spigots tightening, right? They just tighten everywhere. The big bank tightens here, the B lender then tightens next, the private lender has to tighten, and all of this just creates these sort of self-fulfilling liquidity conditions. So like I said, the damage has already been done. The central banks themselves say, hey, it takes anywhere from minimum of 6 to 18 months for monetary policy to work through the economy. Well, guess what? We just raised rates, nearly 400 basis points this year. We don't even know how that's going to work. And like I said, through the housing market channel, that takes time. So the damage, like I said, is already done. We're going to see more of that in the months ahead. One of the things interesting is to see we always kind of knew where the risks were, right? We know the risk was in the private lending. I think the risk is in the pre-sale market, which we've talked about before. The other risk, which I flagged, we don't really have much of it in Canada at all, but in the US, I always had to laugh when you see these iBuyer models, right? So the iBuyer is basically automated software, big tech going up and buying large quantities of U.S. housing at scale and basically buying it and then flipping it for profit. Works great in a bull market, but using a computer algorithm at scale to purchase houses and try to make a profit after realtor fees, lawyer fees, etc., you need a significant lift in the market almost every single month. And again, I don't know if any of you have ever flipped housing. If you've ever done it, I personally have. I personally have in the past gone in, looked for distressed units, in my opinion, units that were not really habitable. They weren't marketable to the market. Go in there, do a full-scale renovation, and then stage it, put it on the market, and sell it. It is a lengthy process. It is not a very profitable business, despite everyone on social media that wants to come out and say that, oh, these people are making boatloads of money, they're the problem for the housing market. It is not a profitable business. I would consider it more of a hobby. So if you're going to do that at scale using computer algorithms, you knew it was a recipe for disaster. So all you have to do is now look at Companies like Redfin, massive company, publicly traded company in the U.S., laying off 13% of their workforce and ending their iBuyer program. We had Open Door, which is one of the leaders in the iBuyer model business. That there was a study that was just done that said 44% of their recent purchases in Q3 were resold below their previous purchase price. And people say, well, 44%, it's not that bad. They said they made money on the other 56%. Well, no. That doesn't account for, they said they resold below their existing purchase price. This doesn't account for, okay, what about the other 54% or 56%? Did they make money? Well, that depends. Are we accounting for the realtor fees in the U.S.? That's about 5 or 6% realtor fee. They're accounting for the lawyer fees, all the administration fees. On top of that, that program, I think all these iBuyers are just going to go completely by the wayside because they're dependent on a bull market. So that's kind of what I was looking at this week. I think like we're continuing to sort of see how I expected markets to shape up, which is, listen, you can't raise rates to this extent and not have collateral damage. The collateral damage is now bubbling up to the surface in really every corner of the markets that you look at. Inflation, of course, when that happens, will obviously begin to roll over. I think it does roll over. I don't think it's a quick down pace back down to 2%, but we're getting there. We're on the path there. It's going to continue to slow, continue to decelerate in the months ahead. But like I said, the name of the game right now is survival. The next, I think, 6 to 12 months are going to be challenging times in the industry. And as we've done in this channel, the job really here is to identify the risks. Again, it's about understanding time horizons. Everybody has a different time horizon when they're buying and investing into real estate. But we need to identify the risks. I think there were risks that we identified earlier this year where, again, we saw a lot of people get caught offside, or they chose to buy first before selling, got caught with 2 properties, having then to be in a very difficult financial situation. So our job here is to sort of educate, identify risks, and let people make their own educated decisions. So hopefully we continue to bring some value here. Appreciate the support, and we'll see you next week.